Now we get to talk about everyone's least favorite subject, and that's IRS penalties. Whenever you're doing taxes, you'll encounter certain clients that either they don't file or they may owe and they're not able to pay, and they'll face IRS penalties. Your job as a tax preparer, you want to try to help your client avoid tax penalties, but also have an overall understanding of what type of actions are going to enable the IRS to assess a penalty to that taxpayer. So this is really essential knowledge for doing taxes. The first penalty that we want to talk about, which is quite common, is the delinquency penalty. This is also called the late filing penalty or the non-filing penalty. And what that delinquency penalty punishes is a penalty for is when you do not file on time, you do not comply with the filing requirements to send in an actual tax return. The penalty amount is 5% of the amount due, so the amount on the tax return that was not done, whatever amount is due when the tax return is done. And if you don't do the return yourself, if the taxpayer doesn't do the return, the IRS will actually do the return for the taxpayer. So whatever is the amount due on that non-filed tax return, it's going to be 5% of that amount, and it's per month. So if you have a tax return that ends up having $1,000 tax due and it's 5 months late, that's going to result in a tax penalty, right, of 5% per month. So 25% of that $1,000, $250. So it's a pretty heavy penalty. It is at a maximum of 25%, and also keep in mind with this penalty is that when the tax return is done, if there is no tax due, so say for instance the taxpayer is actually supposed to get a refund and they didn't file on time, this penalty doesn't apply. This penalty only applies when there's actual delinquency in terms of not doing the tax return, but also there's an amount due when the tax return is calculated, either by the taxpayer or by the IRS. Sometimes what happens is that the taxpayer may file the tax return on time, so they're complying with their reporting requirement, but they just don't have the money to actually pay the tax. Now, there is actually a failure to pay penalty that the IRS assesses as well. And the rate for that penalty is 0.5%, so 1/2% per month of the net tax that's due. So the tax that hasn't been paid by the due date of that payment. So overall, you can see that the penalty for not paying is actually less brutal than the penalty for not filing. So whenever you find a taxpayer, you'll find some clients that come in and they find out that they're going to owe a bunch of tax. So what they do is they choose to not file the tax return. That's actually not a good approach, because if you file the tax return, you will, and you don't pay, right? You will be hit with the failure to pay penalty, but that penalty is less of a percent than the failure to file or the delinquency penalty. So keep that in mind when you're dealing with a client that has tax due but doesn't have the money to pay the tax at that time. They still should file an on-time return to avoid that delinquency penalty. Another quick note is that the taxpayer can be assessed both the delinquency or failure to file penalty and the failure to pay penalty, but the maximum amount is of both of those penalties together should be 25% of the net tax due. So in a way, these two penalties kind of cancel each other out, and it shouldn't add up, endlessly. There is that maximum of 25% of the net amount due. A third penalty that can be charged is the intentional disregard and negligence penalty. And this basically is reserved for taxpayers that are judged by the IRS to really have taken no efforts to comply with the system. So there's there's varying factors that are used to make that judgment call that the taxpayer is negligent or has intentionally disregarded the IRS rules. So for example, if the taxpayer was audited for the same deductions from a prior year and they continue to use those same deductions, don't have any proof for them. So let's say the taxpayer is not keeping any books or records at all. And generally speaking, this penalty is part of the family of IRS penalties called accuracy-related penalties. And accuracy-related penalties are charged at 20% of the net tax due. So again, if someone's getting a refund, they're really not going to face this penalty. But if there is an understatement of tax, so let's say that the taxpayer is self-employed and they're audited on their deductions and they have no books and records whatsoever, and they've just sort of made up all their deductions. They may be charged an intentional disregard of IRS rules penalty because the IRS states that you have to keep records on your deductions. And so they may be charged that extra 20% penalty on whatever tax is due as a result of their deductions being disallowed. So this penalty can be quite significant, and it's part of the larger family of accuracy-related penalties. If there is an understatement of tax, the accuracy-related penalties are 20% of the amount that is due. And the intentional disregard and negligence penalty is one of those examples where that can happen. Now, as a tax preparer, you can make a positive impact on your client's finances by understanding how the IRS charges penalties and trying to give your client the best advice that you can in order to, number one, avoid IRS penalties, but also if a penalty is charged and there's some way to get it taken off, being aware of how that process is done. So always number one thing is to try to help your client avoid that penalty. And in the case of self-employed people, this happens frequently, that they may be charged an underpayment penalty at the end of the year because they haven't paid their tax during the year as is required by the pay-as-you-go system. So as a tax preparer, you want to inform that person, hey, you can save this penalty, you can not pay this penalty if we start making some quarterly payments. Also, there may be situations where, let's say that the taxpayer was hospitalized or has a very serious problem that would provide reasonable cause as to why they didn't pay their taxes or why they didn't file their return. You may be, as a tax preparer, and this is a little bit of an advanced topic, but you may be able to convince the IRS, hey, this client was in the hospital and was not able to do their tax return on time, and that's why they filed late. And you may be able to get that failure to file penalty or late filing penalty erased. So that does happen. It's something that you do need to be aware of. Also keep in mind that with IRS penalties, the IRS charges interest on the penalty amount, okay? So that kind of gives a little bit of a exponential factor to how the IRS bill sort of adds up. You know, it's the penalty, but then they're also charging interest on that penalty. Overall then, you want to really try to help your clients avoid penalties, and when there are penalties involved, see if you might be able to help them get them removed or reduced, and just in general, be able to answer the kind of questions that the taxpayer needs to know. For instance, if the taxpayer is coming in and they're going to owe, and they decide, hey, I don't want to do my taxes, I'm just going to not worry about it, you in your mind should explain to that taxpayer, it's going to be more of a penalty if we don't file your return. Even if you don't have the money to pay, we want to avoid that failure to file penalty. So let's go ahead and file the return, get you set up on a payment plan. You'll still have to pay the failure to pay penalty, but you can avoid that failure to file penalty. And by advising that client in that way, you may be saving that client quite a bit of money.